We're into Friday, and as things stand, the US dollar has enjoyed a nice week, flat against the euro, but up against the other developed currencies. Two of the bigger stories this week were the fallouts in the pound and the Canadian dollar on the back of weak round of data and less hawkish central bank meeting, respectively. The pound suffered setbacks after earnings, inflation, and retail sales were all soft, with the decline intensifying after Governor Carney played down any expectations of certainty relating to a rate hike from the BOE in May, referencing concern over the recent run of data. At the same time, we had been warning of exhaustion and the need for a more significant corrective decline after the market failed to correct enough off the January run-up, which had been slightly exceeded this week. Back in December, we called for sterling outperformance in 2018 and continue to believe the pound will perform well on a relative basis. But for the time being, we see room for a healthy pullback in Q2 before the pound looks to reassert. As far as the Canadian dollar goes, here too, we had thought the loonie had run too far and fast and thought the Bank of Canada did a good job scaling back its hawkishness with an added layer of caution. NAFTA risk cannot be understated, and while there have been positive developments, there haven't been enough to support the recent run of loonie strength in this desk's opinion. But into Friday, it isn't the pound or Canadian dollar that sits at the bottom of the pack on the week. It's the New Zealand dollar that has been struggling most, and we believe here too it has been about misaligned expectations for central bank policy normalization after this week's Kiwi CPI data came in at its lowest levels year on year since the third quarter of 2016. Finally, it's going to be interesting to see how things play out with the euro. The single currency did manage to push to a plus 3-year high earlier this year, but for the most part we've gone nowhere, with ranges only contracting further. We have reached a point where such contraction now warns of a breakout and volatility ahead, and we recommend keeping an eye on the 124.80 level above and 122.15 level below for additional insight. Above 124.80 will expose a push through the 2018 high and into the 126 area, where there is a massive trendline resistance off the 2008 record high. Below 122.15 will likely open a bigger drop to fresh 2018 lows and back down towards the December 2017 base at around 117.20. As far as risk markets go, developments relating to U.S. protectionism, global trade, and geopolitics will continue to be monitored, though as we continue to stress, risk markets are highly vulnerable in 2018 with the monetary policy normalization process ramping up, which will force investors to head for the exits and weigh heavily on the global equity market and correlated effects. As far as today's calendar goes, we get German producer prices, Canada retail sales and CPI, and Eurozone consumer confidence. There's also some more central bank speak to take in. That's all for now.